Good afternoon, everyone. I'm Shesha Shah, and it is my pleasure to extend a warm welcome to all of you to today's webinar, GST 2.0, Navigating the Next Phase of India's Tax Revolution, on behalf of KC Mehta and Co. LLP. Thank you for taking out time to join us this afternoon. The 56th GST Council meeting held on September 3rd, 2025, introduced a set of far-reaching policy changes and clarifications. These developments are not just procedural updates, they mark a strategic shift in how GST will evolve in the coming months. Whether it's changes in compliance mechanisms, policy fine-tuning, or a sharper focus on technology-driven governance, this marks the beginning of what we are calling GST 2.0, a significant milestone in India's indirect tax journey. At KCM, we see it as a responsibility not just to keep you informed, but to equip you with the clarity, context, and guidance you need to confidently navigate this transition. Today's session is designed just to do that. We'll walk you through the key policy updates announced in the Council meeting, their short and long-term implications, and practical insights on how to adapt your business operations and compliance strategies. We are fortunate to have with us two of our seasoned experts, Mr. Bhadresh Vyas, partner, and Mr. Vandit Trivedi, director at KC Mehta Indirect Tax. They will be sharing both a high-level overview and actionable insights that are relevant across industries and business models. Before we begin, let me tell you this is an interactive session and we would encourage you to share your questions in the chat box. We'll definitely take them up during the Q&A towards the end. With that, let me now invite Mr. Bhadresh Vyas to kick off today's session. Bhadresh sir, please.
Sure. Thank you, Shesha, and good afternoon to all participants. The GST Council meeting was scheduled on 3rd, and I'm sure that over a period of these days, each one of you would have actually studied the impact on your products, on your services, on your availability of input tax credit, on your availability of refunds. So, with this social media at times, may everyone, is getting in information, since last number of days, I'm sure that, you would have done the impact, the assessment, what are the changes, what is the readiness required, and specifically, given that the rate change is happening from the middle of the month, how to cater those, right? If revisit the pricing, revisit the contract terms, quite a few, activities would be requiring your thoughts and attentions. And, I was just discussing with Vandit, and Vandit said that, the council meeting was on 3rd. Today we are on 12th. So are we late in having this? So my answer is no, we are not late. We are latest. So GST, we all know that Prime Minister announced, in his budget speech on 15th of August, saying that there is a need for rationalization in terms of rates to do away with cases where there are inverted duty structures, to come out with structural reforms. And he said that this will be a Diwali gift for the entire India in terms of GST 2.0. So then the 56th GST Council meeting was scheduled. And yes, it is coming out as a gift. So, around more than 20 sectors and more than 500 products and services is where a rate change or a rate rationalization has been pronounced. Certain administrative, clarifications have been recommended by GST Council for the government to come out with circulars, amendment in law, which will have a trade facilitation measure. And also there's a pronouncement in terms of operationalizing or how to make effective the GST appellate tribunal up and functional. So right now, GST tribunals are not functional. The second appellate authority is not there. So if someone has a negative order from the adjudicating officer or the first level officer, the only recourse is to wait for the tribunals to be functional. So there's already a circular which has been issued, which says that a pre-deposit would be required to be filed. A letter, needs to be submitted saying that the taxpayer intends to file an appeal. But because the tribunals are not functional yet, uh, this was somewhere creating an issue in terms of repetitive nature of discrepancies or observations from the department. The only recourse, probably was by way of a writ before the High Court, which again, the volumes involved may not be enough to justify the time and effort that would be required for filing a writ petition. So here now the council has recommended a clear timelines with dates as to how the GST appellate tribunals should be made functional. So this is again something which is a very welcome move. So, why this GST 2.0 was required? So one, obviously, it's the 8th year of rollout. So in 2017, various taxes, and duties were subsumed into a single levy, GST. And this was, a very major change in terms of indirect taxes in India. So obviously, 8 years period was a time where the experiences, the feedback, the representations from trade and business were collected. The present government is very receptive about the ideas, the suggestions, the recommendations from trade and business, and they have a clear focus is obviously there in terms of listening to what the taxpayers feel. So while obviously the objective remains on robust compliances, the number of registrations, the volumes of tax collected by government, if you observe, year on year is showing a significant increase, right? So while the threshold limits haven't changed right since 2017, the number of taxpayers have increased significantly. The year on year collection has increased significantly. So in fact, last year it was a more than 9% year on year growth. So obviously inflation and all those would have a play, but even if that has to be discounted, the compliance is in GST, obviously the focus, the taxpayers' receptiveness is increasing. And government is also very keen and focused on ensuring that everyone does the compliances correctly. So heavy focus on automizing the stuff, on having checks and balances through electronic filing of returns, physical controls, to the extent of e-way bill, road permits, and all those, are still there in a way. But then, all of this is actually resulting into something where GST is turning out to be a value-add proposition for trade and business over a period of 8 years. So, in fact, recently a survey was also conducted wherein 85% of the taxpayers in India say that GST for them is a value-added proposition. So compared to the earlier set of rules, 85% of the taxpayer in India are happy with GST. So this something is a very positive sign, more so because India, which is such a diverse country, to have a major tax reform of this size and volumes, and, to ensuring that everyone is complying, is, doing the way government wants it to do, despite the infrastructural challenges which were earlier observed. This is something which is very commendable, both on the part of the government and also on the part of the taxpayers of India. Another very good thing, over this period of 8 years is the way laws around GST have been drafted, formulated, and pronounced. So when earlier there were multiple taxes, both the state government and the central government had their own set of legislations where they were administering or those taxes. But now with a single unified tax across the country, a need was felt that we should not end up with multiple taxes within the same country. So one nation, one tax, should be both in letter and spirit. And therefore, through a constitutional amendment, the GST Council was formed. And a very exciting, and personally, I'm very proud of that. Something that so far 56 meetings of GST Council has been scheduled, and in none of the meeting, central government had to use its veto. So that is something very mature of our lawmakers, of the government, both state and center, that all throughout in these 56 meetings, there have been an absolute consensus in terms of what GST Council is recommending. So GST Council takes, the responsibility of recommending the change in law. Then the respective central government for CGST, IGST, and respective state government for the state GSTs would have to come out with the change in the laws implementing the recommendations of the council. So even recent, that on 3rd and 4th, the GST Council meeting, which was scheduled, the 56th GST Council meeting. So there again, there was a consensus in terms of rates that were being proposed, the rationalization, the doing away of inverted duty structure, certain pronouncements on trade facilitation measures. So in fact, the council meeting was supposed to be scheduled for 3rd and 4th, but they were able to wind up the entire agenda in day one itself. So this, again, despite of the differences in the political view of each of the state finance minister or the union finance minister, this is something, which we all should be very proud of as India, that our economy, the tax structure is so mature that we are able to come out with a consensus across all state FMs and union FMs, and 2 day ka agenda we are able to close in day one. So on this third, when the GST Council made the recommendations, I would categorize broadly those recommendations into 3 broader areas. One is the rate rationalization, where they have changed the rates. Right? So they have reduced it for most of the cases. For some services, they have also increased. The second is trade facilitation measures. So the GST Council has recommended to the central government to come out with change in the act, the law, or to come out with a circular for better tax compliances and avoiding of undue litigations. So those, I would bucket it into a second bucket with trade facilitation measure. And the third, as I discussed, there's also a recommendation in terms of making the GST appellate tribunals operational. So my entire talk, in this webinar would be on these 3 buckets, and each one of it I would take one by one. So on the changes in the GST rate, when GST was introduced in 2017, there were 4 slabs typically, which were decided. So 18% was considered as a revenue neutral rate. So earlier we had excise, service tax, VAT, so all those were subsumed, and a revenue neutral rate of 18% was fixed. So most of our products, goods, services would be under 18%. But then we also had a merit rate of 5% and 12%, and a demerit rate of 28%. Then there was also a compensation cess, which was levied earlier from 2017. That was again with a particular timeline, mainly to, to compensate the states for the loss in revenue. So center would collect that and compensate to the states for the loss in revenue that the states would have been suffering. So broadly, we had 4 tiers rate structure: 5, 12, 18, and 28. Now the recommendation is to do away with slabs of 12 and 28. So any goods or any services which would were earlier under 12% would either come down to 5 or would go to 18 or a higher rate. And similarly, all goods and services which were earlier under 28% would also be reclassified either as 5 or 18 or at a higher rate. So now broadly, we would have 2-tier structure, 5% and 18%. Government also intends, or rather council has recommended government to come out with a higher rate of 40% as well for certain sin goods and luxury items. So when I say luxury items, is certain motor vehicles, exceeding certain prescribed capacities, hybrid vehicles, non-alcoholic beverages, all tobacco products, aerated drinks. So those are, which are government do not want to promote, or online gaming, betting, all those stuff, would still have a higher rate of 40%. But otherwise, bearing those thin goods and luxury items, all goods and services will now be taxable at 5% or 18%. So very important point here for all of us is, if today any of our product or any of our services is under 12 or 28, we should revisit that, because that obviously is going to change. because now no 12% and 28% will no longer be continued as a rate, effective rate. So if my product or service today is at 12%, obviously it is bound to change. Same way, if I was under 28%, it's bound to change. Second point that I would like all of your attention is, do not focus only on your outward supplies. Also do focus on your inward supplies. So there may be a case that your product was anyways under 5% or 18%, but you were procuring goods or services which were either at 12 or 28. Then it's imperative that you revisit your terms of purchase order, your communications with the supplier, and ensure that your supplier also charges you correctly. The changes in this rate would be effective from 22nd September. So right now it's the recommendation from the council, basis which the government would come out with a rate notification. That rate notification also has been recommended by council to be made effective from 22nd of September. Why 22nd September? Because Navratri, is seemingly starting from that day. So government wanted to have this change in rate from an auspicious day, and therefore 22nd September has been fixed as a date from which these changes in GST rates would be applicable. Except on cigars, chewing tobacco, products and bedding. For that, effective date would be notified separately. But otherwise, barring those, all those 500 plus items, or goods or services that are getting changed, the rate would be effective from 22nd September 2025. I've listed here few of the sectors which would be actually, uh, impacted because of the change in the rate. So if you are in any of this sector, you are getting impacted because of these changes in the rate. So food, fertilizer, paper, packing material, textile, agriculture, automobile, life and in general insurances. So these are the sectors that I have kept in here. So either you are into this sector, right, where you are output rate obviously is good bound to change. But if you are also procuring goods or services under any of this sector, say for example, you may not be under any of this sector, but for your products, you would be requiring paper or packing material, right? So now the rate of GST on packing material is also undergoing a change. So if you are procuring goods under 4819, obviously you would also be impacted because of this change. So here again, I would reiterate that focus not only on your outward supplies, but also, you should be focusing on your inward supplies, determine the rate correctly. The rate changes would be effective from 22nd September 2025 itself. This table shows how to determine what rate I should be charging. So typically, for any transaction, any supply, there would be one, a supply of that particular goods or services. Second, a invoice raised for that particular supply of goods or services. And third, a payment received for that particular supply that was made. So if the supply was before 22nd September, your invoice has also been raised before 22nd September, and payment also received before September, then obviously you will be subject to old rates. If your supply was before 22nd September, but you are raising invoice after 22nd September, and you are getting payment also after 22nd September, then new rates would be applicable. So basically, what we loosely refer this as 2x3 rule. So supply of goods or services, invoice raised or payment, any two out of these three is on which side of the date, that date typically would be applicable for your determination of time of supply. Same way, if you're making supply after 22nd September, even though your invoice was raised before 22nd September, but you receive payment after 22nd, then the new rate would be applicable. Because both supply and receipt is after the date, even though you would have raised invoice before. So in that case, new rates would be applicable. So this is, something which we all should be very mindful of. For each of our transaction of inward supply and outward supply, we should note what would be the time of supply and accordingly determine whether the new rate, which is going to be notified, now and be effective from 22nd September would be effective for me, or I would be subject to the earlier rate of tax as well. So here again, on your POs, on your inward supplies, also I request, that this time of supply should be determined, because if your supplier is charging you a lesser rate, and maybe, at a later date, he would realize, so while obligation is on the supplier to determine the time of supply correctly, to charge the rate correctly, but commercially, he may still come back to you and bother you saying that, I charged the wrong tax. Please now, honor my debit note or reimburse me the additional amounts and all this. So to avoid such, maybe commercial discussions or otherwise any sort of discussions, my request is ensure that you determine your time of supply correctly, both on your outward supplies as well as your inward supplies. Now, this change in the rate is going to be effective from 22nd September. So 21 midnight and early hours of 22. 21 September is a Sunday. So if in your ERP, the changes in the rate, may be done by your tax team or by your consultant or your, just ensure that they are available on 21st September, okay, on Sunday, to ensure that your ERPs and systems are updated accordingly, so that from 22nd September, the correct rates are levied in your terms of your purchase orders, in terms of your invoices and everything. Now so this is the change in the rate. So on the specific products and sectors, I've attached as an annexure. Maybe, if required, I can take you all through separately what are those changes. But right now, as I said, for various 20 products, the rates are getting changed. Okay, so for if you are under any of this sector, food, fertilizer, textile, life and insurance, consumable electronics, automobiles, the rates would be changed or you are somewhere impacted. Now, what could be that impact? One, say your goods were taxable at a rate of 12% as per present tax structure, and with effect from 22nd September 25, it's going to be exempt. So, there are a number of products under food sector which will be covered under this. So say, for example, if you are under food sector, today your product is taxable, but with this recommendation, the revised rate, which will be going to be effective from 22nd September, it will be having a nil rate or no tax on the outward supplies. What will be the implication? So one, obviously, when you raise an invoice going forward, you will not be required to charge GST if your time of supply is also after 22nd September. That's one point. But the second, there would be also be an implication on your input tax credit. Because these goods now are becoming exempt from 22nd September 25, you will not be entitled to claim input tax credit on procurement of such goods or for procurement of raw material, packing material, anything for those goods. So one is outward, you will not be levying tax, but the corresponding effect is obviously you will not be entitled for your ITC as well. So there may be a case where the reduction in your net pricing to the customer may not be actually the same, as a reduction in rate. So say, for example, today I'm charging my product as 100. I am levying a tax of 5, and 100 in 5 is what I am collecting from my customer. Now tomorrow that 5 is becoming nil, 0. So ideally, my invoice should be 100 but 0. That will not be the case, because when I said worked out 100, I would have considered the benefit of input tax credit to me. Now, because these products, this survey are getting exempted, I will not be getting an input tax credit. So my cost plus margin, which was earlier 100, may work out to 101 or 102. So in that case, my MRP would be 102 plus zero tax. I hope I'm clear, right? So proportionate reduction in tax because of exemption will not be the same as proportionate reduction in MRP going forward. You will have to consider the net impact, the impact of non-availability of your input tax credit. So this is something very important for all of us to note. We'll have to revisit our cost sheets, our computations, how our MRP has been determined. Right? So that we'll have to all do. Video pause हो रहा है? Sorry. I just got a message that my network is slow. I'm not sure what I can do differently for that, but if someone can confirm in chat, if able to hear me now. The voice is clear, then it's fine. Okay, fine. Done. So I'm happy that people also want to see me and hear me. Good. Sure. So I'll continue. So one, I was saying that reduction in rate and reduction in MRP may not be exactly the same. That is one point. Second important point here is, if say I'm a trader, I'm trading in those goods which are getting exempted from 22nd September. So today when I purchase the goods, okay, when today the rate was 5%. So when I made an inward supply, I was levied a 5% GST. That was my input tax credit. But now from 22nd September, that product is becoming exempt. So I will not be paying any GST when I make a further sale or a further outward supply of that particular product. So now because I am going to make a supply as an exempted sale, as a supply with GST nil, the input tax credit on stock will also lapse. So there's no provision under law under which I can claim a refund or a carry forward of such unutilized ITC of stock as on change of rates. So this is again, something which we all should work out, should recompute. So if my product is getting exempted, and if I have a stock of those products on which I would have availed ITC, I would have also paid to the supplier. And it may be the case that I would have also complied with all conditions under law. Right? Despite that, that unutilized surplus input tax credit in stock as on 22nd September for the goods which are going to be exempted would lapse. I would not be able to claim a refund, neither I would be allowed to claim a carry forward of that. So this again is something, which would have a major impact. We all should consider that in our pricing. Right? So when we are saying that my product is getting exempted, one, going forward, I will not get ITC is one, but even for the stock as on date on which I already paid ITC, that ITC will also lapse. I will have to reverse that ITC. So there would be an impact of that as well. So here, two very important points that we all should be noting and ensuring is one, we revisit the impact of ITC on our profitability, on our working capital for the stock and for the transactions going forward. And second, accordingly recompute our pricing of goods and services. The second case that I'm taking now is where GST is not exempted, it is not becoming nil, but the rate of GST is getting reduced. Right? So take a scenario where today the product is taxable at 18% with effect from 22nd September. The product would be taxable at the rate of 5%. Right? So now consider a case where I have purchased the goods. Okay, so I purchased the goods by paying 18% to my supplier. I have a valid invoice, I have receipt of goods and stock, services, and that 18% is available as an input tax credit with me. Now the stock remains with me unsold as on 22nd September, and the rate is changed from 18 to 5. So what would happen to this surplus ITC? So in the earlier case, when we saw that the product becoming exempted, the ITC lapses. Here, because the product is not getting exempted, it still remains taxable, maybe with a reduced rate. My ITC will hence not lapse. So the input tax credit of 18%, which I have in my stock, would still remain with me. It will not lapse. I need not reverse that ITC. But the only point is that my output liability for a particular period may not be enough to take care of that entire surplus input tax credit. So then I may be forced to carry forward that surplus ITC for a further tax periods. That means in this case, this can still have a working capital impact for me, not a P&L impact, because products still remains taxable with a reduced rate. So ITC, which is already available on stock, would not lapse, but I will also not get a refund of the same. So the only option is I would have to continue to carry forward it till the time I have a further outward liability, which is good enough to take care of this entire surplus ITC. So this again would be an issue specifically for all taxpayers who have a distributor model, right? So say, for example, I am a principal, I have appointed a distributor. The distributor is going to make a further sales. So now I supplied the goods at the current rate, which is at 18%. As on 22nd September, the distributor is holding that goods in his stock. And now there's a change in the law rate, and that 18% is becoming 5%. So if distributor was supposed to earn a margin of say 10, he would make a further supply of 110 and levy a GST of 5 on 110. So now 5% of 110, which is his output liability, may not be good enough to take care of entire set off of 18 paid on 100. That means the distributor may have a working capital blockage. And obviously, as a commercial precedences in India, if the distributor is going to have any working capital impact or non-availability of ITC, non-utilization of ITC, obviously the distributor would come back to the principal. So the principal, I should be concerned about the working capital of my distributor as well. And I will have to work out a mechanism by which either the margins are enough so that they are able to take the set off entirely, or maybe we'll have to come out with some mechanisms whereby either the stock is reduced till 22nd September if we have time for that, if we do some structuring and planning on that. Otherwise, this ITC blockage could happen at the distributor's end. So here again, a very important point to note is, so 18% goods becoming now 5%. So that's a reduction of 13%. But my reduction in MRP need not be necessarily 13%. Because I would have to still compute the impact of my working capital blockage. So here also, if any of your products are getting impacted and there's a change in the rate, reduction in the rate of tax, my request is we should revisit how either ITC would flow in, how the current utilization happens, if there are any surpluses, would it add, would there be any additional impact on the working capital, and then recompute our pricing accordingly. On this refund point, so the government is very clear that they will not be allowing refund for such cases. They also in 2020 had came out with a circular saying that if my input and output is same, mere change in the rate would not qualify as an inverted duty structure, and therefore refund should not be allowed. In fact, in the recent FAQ, which was publicized by government post GST Council meeting, there again they have repeated the same thing. They have said that refund would not be available. But this is a circular, and certain high courts, three of the high courts, Delhi High Court in case of IOCL, Guwahati High Court in case of BMG Informatics, and also Rajasthan High Court. The three high courts, Guwahati High Court, Rajasthan High Court, and Delhi High Court, have already taken a contrary view. They have said that this circular, which restricts claim, is bad in law. That circular, should be withdrawn or should not be made against the taxpayer. So right now, if I talk about intention of the government, which was through circular and also repeated in the FAQ, it seems very clear that government do not want to allow refund, do not want to consider this as a case of an inverted duty structure. But as I said, certain high courts have taken a contrary view. So this is something, which can be explored by way of a REIT. But REIT, I would suggest only and only if the volumes involved are very significant to take care of the time and effort that would be required in getting that orders from the High Court. If the amounts are not those significant or the risks are not there too high, my suggestion would be to go by with what the government intention is. Right? They do not want to allow refund for such cases. So then work out with alternate mechanisms so that you are not adversely impacted. The third case I have considered is where today the product is taxable at 18%. Tomorrow, the product will be taxable at 5%. Now, for procuring those goods or for manufacturing those goods, I am getting inputs which are today taxable at 18%. So today my inputs were at 18%. My output was also at 18%. Going forward, my input would remain at 18% and my output would be at 5%. So what would happen in that case? This is a typical scenario of an inverted duty structure. So here, the refund as well as carry forward both would be allowed. So inverted duty structure typically means where rate of tax on inputs is higher than rate of tax on outputs, and because of which I am resulting with an unutilized surplus input tax credit. So here, because my inputs would come at 18% going forward, my output would be at 5%. I would be allowed to claim a refund under inverted duty structure. So three cases we observed. One, where the goods are getting exempted. There, a P&L impact, ITC on stock will have to be reversed. Second, where rate is getting reduced. Where there, no P&L impact, ITC may not be reversed. But I will not be granted a refund. So at the most, there could be a working capital blockage. And third, a case where it's an actually inverted duty structure ka case going forward. There, I would be allowed a refund or a carry forward, either of. Another welcome recommendation by the council this time is they have said that for such cases of inverted duty structure, along with cases of export, a 90% refund should be granted provisionally upfront. So this is something, which is a very good recommendation by GST Council, because, 90% at least, my money would be upfront given within 7 days. Then government can within 10%, they can do a detailed scrutiny, audit, assessment, and satisfy that my claim is genuine and that the balance can be released. But at least my 90% would be immediately, I would be able to realize. So this recommendation has also been made by the GST Council, and they have said that this will be made effective from 1st November 2025. So this is something which for all cases. So if you are under pharma, under automobile, under certain food products, you would be covered under IDS going forward. So if you are under IDS, even for e-vehicles, which is even the today's case, right? So for electric vehicles, the rate is 5% on the output, but the rate on inputs is higher. So today also they are under inverted duty structure. That would continue even, going forward after 22nd September 25. The only good part or something, to cherish is that a 90% provisional refund is been recommended by council that government should process that upfront, obviously subject to risk assessment. So they will come out with the risk parameters. If the taxpayer is not identified as a risk taxpayer, then 90% is something which can be realized within 7 days. So under inverted duty structure, right now the surplus ITC on inputs is available. But if there's a surplus ITC because of input services, that is not available. And that, so there was a Gujarat High Court ruling saying that for services also refund should be granted. There was a Chennai High Court ruling contrary to that. The matter went up to Supreme Court, VKC footsteps, and we all know that, right? How judicial pronouncements around there evolved. And Supreme Court confirmed, and then government also made it very clear that for input services, they do not wish to grant a refund under IDS. So that challenge would still continue. So even if you are under inverted duty structure, and if there's a accumulation happening because of your input services, so if your input services are 18% and your rate on output is 5, for that because of that accumulation due to input services, claiming refund would still not be available. Because of this change in the rates, obviously, outward is very easy. We'll have to map that in our ERP. We'll have to come out with that change in the rate. But the three specific cases that I discussed, where also my corresponding ITC would have an impact, I will have to consider that, and we'll have to work out my revised pricing that I should be offering to my customer going forward. Now, if I'm covered under Legal Metrology Act, then obviously, this MRP having that fixation of pricing on my products or the stickers on the packing material is a mandate. But if I'm not legally covered under Legal Metrology Act, then also the government expects taxpayers to pass on the benefit in reduction in rates to the end consumer. So in fact, the finance minister, the revenue secretary in their tweets and also in the interviews and whatever press notes and whatever, they have communicated, they have been very vocal in saying that the reduction in rates has been made so that the end consumer, the common man of India, is getting benefited. So they would be closely monitoring that the industry, the taxpayer, is actually passing on the benefit of reduction through MRP because of reduction in rates. On 9th September, a guidelines was also issued by Ministry of Consumer Affairs, wherein it says that the proportionate reduction in the GST rate should be the same amount of as your reduction in MRP. This, in my view, is not correct because, earlier I was getting various ITC. If my ITC is getting blocked, if I'm not able to get that fully, obviously that reduction in rate would not be the same as reduction in my MRP. I will have to rework my MRP and then I will have to affix that. The guidelines also says that, if there's an MRP which is already printed, then I should have another MRP disclosed on my material. The original MRP must continue to be displayed. So I should not overwrite it. I should not affix another sticker on it. The original MRP should continue to be displayed and the revised MRP should also be declared. The difference, as I said, that may not be correct, while the guideline says that difference would be the same as reduction in rate. But in my view, this is not a correct statement or a correct proposition to have. The guidelines also says that the reduction or the change in MRP, I should be disclosing at least through 2 advertisements. And I should also write notice to dealers, then the director of legal metrology, both at the center and the state level. Any packing material, which is there already at my warehouses, depots, tied, with those earlier set of printings, There, the guideline says that I should ensure to utilize it before 31st December 2025 or till the date that actually is utilized, whichever is earlier. So basically 31st December 25 is an outer date which has been now been prescribed for use of all unused such packing materials. Day before yesterday, we had also come out with a flash. So I'm sure KCM ka flash would have been received. So we have come out with a detailed flash and an alert on these guidelines and how to deal about this and what is KCM ka as a firm view on adhering to those guidelines. So one, these guidelines of Ministry Consumer Affairs. Second, compliance with Legal Metrology Act and provisions under that. And the third important point in terms of rate reduction is compliance with anti-profiteering provisions under the GST law. So when GST was rolled out in 2017, when various taxes were subsumed and a single levy was formed, quite a few input tax credit which were not available under the earlier set of law were made available under GST. A classic example, say if you were someone was a trader, right? So he was procuring on payment of VAT, selling on payment of VAT. He would also have been procuring certain services on which he would be paying service tax. Now, a credit of service tax was not available against output VAT. Same way for a service provider, a credit of input VAT was not available against output service tax. When these all levies were subsumed into GST, the fungibility or utilization of ITC across goods and services increased. Right? So traders also started getting benefit of service tax on services. Service providers also started getting credit on inputs. Right? So my ITC pool increased when GST was rolled out. And therefore, in 2017, government had specifically included in the law book, section 171, which says that if there's any benefit happening to the taxpayer because of more availability of ITC or because of reduction in outward rates, that benefit should be passed on to the end consumer and it cannot be profited, it cannot be pocketed by the taxpayer. So that was, when globally, wherever GST was introduced, a sharp increase in the inflation was observed. So our lawmakers, our government was very, mindful and thoughtful of that. They wanted to have a check on inflation, and therefore anti-profiteering provisions were made part of the GST law by way of Section 171. They had also prescribed a mechanism by which anti-profiteering measures can be implemented. So if someone has a complaint or an issue that his supplier is doing anti-profiteering, is not passing on the benefit, there was a mechanism prescribed, by which he can escalate that, and there was an authority notified. The authority so notified had a sunset clause. So right now, when we speak in 2025, today we do not have a formal authority to take complaints or cognizances of cases of anti-profiteering. That means while there's a law under GST, there's an act, provisions or a machinery enabling that law is not in place. So today, strictly, if someone has to say, is anti-profiteering mandated under GST law? The answer would be, while it is required under law, it cannot be mandated because of absence of administrative mechanism around that. So this is something, which is very important for all of us to note, because right from 3rd July, in various forums, various, public media, everyone is sharing their thoughts. The government is very vocal, saying that they would monitor anti-profiteering provisions. They would want the tax benefit to be passed on to the end consumer. But can they mandate that under GST law is something which is debatable. Now, if they have to revoke that mechanism, right, then also basis a recommendation of the council that would require a change in the law. So right now the council, in the recent meeting has not recommended that. So then, it will be a long shot where the council again will have to recommend change in the law, come out with a revised anti-profiteering mechanism to administer that. And post that, this can be implemented. So right now, one, for the reduction in rate changes, if I'm covered under Legal Metrology Act, obviously I will have to comply with the guidelines. I will have to adhere to the rules under legal metrology. That is point one. Second, my competitiveness, so if my customer is reducing the prices, I would be forced to reduce the prices. That is another aspect to it. And the third, honoring the contractual obligation. So if under a contract with my customer, I have said that any reduction in GST, I would pass it on, then obviously I will have to commercially honor that contract as well. So those parameters would still be holding good in terms of passing the benefit, but strictly as an anti-profiteering under GST law, it's not clear. It's still debatable. I can very well choose not to pass on the benefit to the end consumer. So this is something, I wanted to have all your specific attention, because while, you will be reworking your MRP, do that more from a contractual obligation, do that from a competitive market standpoint, requirements. Strictly under law, we can still debate on it, come out with an alternate solution. I may not be strictly mandated to pass on the benefits. So this was, entirely on the rate change. The second bucket, as I said, were certain trade facilitation measures, where the GST Council has recommended that government should come out with change in the law or circulars, for ease of doing business, ease of doing tax compliances. So one, we already discussed that they have recommended that 90% provisional refund should be granted upfront within 7 days with effect from 1st November 25. So this is a welcome move. Certain changes also been recommended for faster registration. So, for small taxpayers, that is again, very welcome move. A very important recommendation is with regard to change of place of supply for an intermediate service provider. So under IGST Act, there's a concept which is defined as an intermediary, which typically means a person who arranges or facilitates supply of services between more than one person. So to give an example, there's an overseas company who wants to buy goods from an Indian supplier. Now the overseas company is appointing the Indian service provider, to visit the site of that supplier, do a due diligence, expedite the work, and then that supplier would be dispatching the goods directly to that overseas company. So the role of that consultant here is only to arrange supply from the supplier to the overseas customer. He is not making his own supply directly. He is expediting, arranging, facilitating, right, a transaction between more than one person. So this typically you would be deemed to be providing services as an intermediary service provider. So the law today says that for determining place of supply, that for an intermediary service provider, it would be the location where the service provider is located. So in the example that I gave, if the person who provided these intermediary services is in India, even though his customer is outside India, he was supposed to charge a GST because his place of supply happens to be within India. Okay? And this GST obviously was a cost because the overseas customer would not be entitled for any input tax credit of Indian GSTs. So here the council has now recommended that place of supply for such intermediary should be changed from location of service provider to location of service recipient. So that means going forward, if I am an intermediary service provider in India, but if I'm providing services to a customer who is outside India, now location of recipient is outside India, that means it would qualify as an export. It will qualify as a zero rated supply. I need not charge any GST. So this again is a very welcome recommendation. More so, because the GST has been a concept of destination based tax it should be levied, tax should be levied where get services getting consumed. So for intermediary, there was a disconnect that for such certain services, the benefit could be consumed outside India, but still a GST was applicable. So here the change has been recommended by council, but this would require a change through change in the law. So this is the recommendation. Now they will have to amend the provisions of the act. Act can be amended only, once they pass a finance bill, the Lok Sabha will approve, the Rajya Sabha will approve, the president will sign. Then it will become an act. So not an immediate, this can be made effective, but obviously the recommendation there that it will eventually come. I hope it comes sooner. So with that amendment in the act, maybe at least by latest, the upcoming union budget, we can expect this. This would be a big relief for all where, there's an intermediate service providers in India and providing such services to customers outside India. So here again, refund would be allowed because you are will be considered as an exporter of services. 90% upfront, which is again, very welcome recommendation. So this is something, which will be a great relief for intermediate service providers. For all present and ongoing litigations, proceedings, the tax position as per current set of rules would continue. So this will be from a date when the law is amended, and in high chances, this will not be made retrospective. It would be made prospective only. So my present challenges will still continue, but once the law is amended, we will see the benefit of this as an intermediary service providers. Another recommendation made by the GST Council is for the government to come out with certain circulars on post-sale discounts and an amendment in the act. So right now, if I made an invoice, I levied a GST. At a later date, I have to pass on any discount, right? So that I can do through a credit note. The requirement under the law is I can do that as a credit note, issuing a tax credit note if one, there was a specific agreement with my customer that at a later date I'm going to offer such post-sale discount, and that agreement was there before the first supply was made, before the invoice was raised. And the second requirement was that my credit notes would have to be linked with the particular invoice. Now the council has recommended that both these conditions should be done away with, meaning thereby, even if I do not have a specific agreement saying that I would be passing on post-sale discounts, if at a later date I am going to actually pass on a discount, that would be allowed. So this is again, which is a very welcome move, because how to have that agreement was again, not very clear. So there were, certain litigations, queries from the department around that. So these are something, which council has recommended. This is again a change in the act, the change in the law. And once it is implemented, it would be very much possible to pass on a GST credit note as a post-sale discount, even if the agreement did not have a specific agreement with that. Council has also said that, to withdraw a earlier circular, which was issued requiring certification for recipient for reversal of ITC. So here, take an example. I raised an invoice for 100. I levied a GST of 18. So I collected 18 from my customer and deposited it with the government. At a later date, I'm issuing a credit note of say 10. So on 10, 1.8 GST, I'm issuing a credit note. Now that 1.8, I would have allowed to set it off or claim as an adjustment against my liabilities only if my recipient also has reversed the ITC. Now, how to track whether the recipient has reversed the ITC was not specifically prescribed anywhere. So in June 24, government had came out with a circular saying that a certificate would be required to be issued by the recipient, right? So the recipient, if he is getting credit note, he'll have to issue a certificate saying that he has either not availed the credit or if availed has reversed the credit. And a threshold of 5 lakh rupees was prescribed. So if the value of GST adjustment was less than 5 lakh, then a self certification was good enough. But if the value was more than 5 lakh, then the circular said that that certificate needs to be from a chartered accountant or a cost accountant. So this is something, which was unnecessarily creating issues in getting that certificate. So now the council has recommended that that circular should be done away with, should be withdrawn. The moment this circular is withdrawn, there will be no longer a requirement to get a specific certificate from my customer saying that they have reversed ITC if I have to adjust ITC. Right? So this is again a very welcome move. And on three specific topics, again, council has recommended government to come out with circulars, non-reversal of ITC for postal discounts through financial credit note. So here the issue was that I issued an invoice, I levied the tax, say on 118. At a later date, I'm issuing a credit note of 10. But that credit note I want to give as a financial credit note or a commercial credit note. So I will not adjust my GST liability on it. So it will be just a credit note with for the basic value 10. So for the recipient, his purchase price is becoming 90. 100, the original invoice minus value of 10 credit note. So his purchase price becomes 90, but it ITC remains at 18. So there were disputes, which were raised by ground level officers saying that even though it's a financial credit note, the recipient should also have reversed the corresponding ITC. So here now the council has recommended that to come out with a clear circular that it would not be required and financial credit notes will not have any impact on GST outward liability of the supplier or GST input tax rate of the recipient. So these circulars are still awaited. Second, two more circulars on the treatment of post-sale discounts, whether it should qualify as an additional consideration or not, and where the distributor is doing any activity, any sales promotional activity on behalf of the principal, how to treat that post-sale discounts. So here again, the council has recommended government to come out with specific circulars. So once this circular is out, my recommendation is that we all should revisit specifically, if I'm in the business where I have to issue credit notes, if I have a distributor model, principal, distributor, principal agent, whatever, then obviously this will be very imperative and this would have implications. So we should be revisiting the already adopted tax position if any. The third bucket was with regard to operationalization of appellate tribunal. So here the council has now given clear timelines. So they have said that GST appellate tribunal should be made operational to take appeals by end of September 25 and should start hearings at least before December 25. And 30th June 2026 has been kept as a date for limitation for filing of backlog appeals. They also recommended that the principal bench of tribunal should also serve as a national appellate authority for advance rulings. So this is again, some very welcome recommendations by council, because in absence of tribunal right now, litigations are increasing for specifically for repetitive matters. The money 20% is getting blocked as a pre-deposit. So, this is something, which is very welcome. And we hope that, the tribunals are functional as per the timelines which has been recommended. So this, where the broad changes and the impact for each one of us. If I have to summarize, what will be the key items, right, for all of us? One, obviously to update rate masters, both on inward and outward, to determine my time of supply. And for all supplies that are going to be made effective after 22nd September, I should be ensuring that my systems, invoices, PO, sale order, are geared up to capture the new rates. Vendor communication is something that I will again, request all of you to take a note of it. So inform the rate changes wherever, applicable. Inform them the requirement of passing on the benefit. What government is expect may not be under the mandate, but as an expectation of government. If there are any ongoing purchase orders, revisit the terms, how to ensure that, from a cutoff date, the new rate is charged. If you are holding inventory as on 22nd September, determine the impact, One, in terms of non-availability of ITC going forward. Two, only carry forward of ITC, non-availability of refund. And third, availability of refund as well. Right. So please do that determination, that number crunching would be required, and then come out with what should be your pricing with effect from 22nd September 2025. So these were, my thoughts on this, and my advice, recommendation for all of us, that what we should be doing to ensure that, the benefits which the government wants for, all of us are actually leveraged. But at the same time, in passing on those benefits or realizing these benefits, we don't end up with unutilized surplus ITC or ITC blockages around that. Yeah, in terms of sectors, I will be sharing this presentation also with all of you. So, it's fine. I'll not go into details. We can straight away go to the Q&A and, if there are any points by anyone.
Yeah, so sir, we have a few questions. I'll go one by one.
Sure.
First is Mr. Deepak has asked, are there any changes in GST RCM rates?
So RCM per se is not, made as a change, but yeah, for GTA, there's a change, but not specifically for RCM cases. It was earlier 5, now 5%. So rate determination actually would determine on the nature of service or goods that I'm going to procure. Right? So for specifically what Deepak, if your question was around GTA or sponsorship or those type of services, the rate of 18% still remains. There's no change in that.
Okay. The next question is 0.1% rate for merchant trading is still available now. Is available now? Mr.
Yes.
Benny has asked this question.
Right. So those still continue. Okay. So if I'm a merchant exporter, the same set of rules, the same procedures, everything continues. No change in that.
Okay, Mr. Parth has asked, what will happen to my current ITC if my outward supply will be exempted from 22nd September? I think this.
So when you say current ITC is one for the pertaining to those goods which are getting exempted. So ITC attributable to those goods would lapse. You'll have to reverse the ITC. You will not be able to claim a refund, neither you will be able to claim a carry forward.
Okay. The next is Pooja Bansal has asked, rates like 0.1% and 3% will remain the same?
So 0.1 for merchant export, yes. For goals and those specified, very few, those rates continue. So no change in that. So the major change, for there would not be any goods now with 12% or 28%.
Okay, one more. Will zero or nil rate on insurance be applicable to corporates for mediclaim insurance and term insurance for taken for their employees?
Sorry, for corporates. So it's only for individual health and life insurance, right? So right now for individual health, individual life, the rate of 18% is there, which now has been recommended to have exempt as a zero. So that's only for individual life insurance and individual medical claims. But here
Mr.
again, I will again reiterate that right now, time of supply also would be very important to determine, even for insurance claims, point one. And second, the reduction in your insurance premium may not be exactly 18%, right? Because there would be a non-availability of ITC, which would be somewhere built in the premium, and that would be also be passed on to the consumer.
Okay. Amaresh has asked, my output tax is 28% before 22nd September, and after 22nd, my output tax is 18%. If I have raised the invoice 18% before 22nd September, later I have to raise the credit note after 22nd September against the invoice raised before 22nd. The credit note output tax rate will be 28 or 18%.
So, Amresh, if I understand you correctly, the query is what would be the rate of GST on credit note, right? That is what you are asking. So my invoice was before the change in law. So obviously with an earlier rate of 28. Now the rate is getting changed. And after that date, I'm supposed to issue a credit note for an invoice which was raised earlier, right? If that's the question, then my response is the rate as per earlier invoice will only hold good. So say for example, today I am making a supply of invoice 100 plus 28. 22nd September, the rate becomes 18. In October, I have to issue a credit note. Okay, say for example of 50. On 50, I would still levy a rate of 28%, not 18, which will be rate effective then. Logic being, credit note I can issue only one when there's a reduction in the value of price supply, or the services were not provided to the satisfaction of the customer, or they actually were not provided. Right? So in all these three cases, the value which I have levied earlier has to undergo a change. So that has to be the same which was levied in the time of original invoice. So government will not be allowed to pocket the money. So if I was to charge only 18% going forward, that means I made a supply at 20, I raised an invoice at 28, paid tax of 28. But if credit note is allowed only at 18, that means government would end up pocketing 10 rupees, which is not correct, which is not allowed and should not be there. And therefore, GST credit note also should be as per the same rate which was there as per the original invoice.
Okay, Mr. Samir has raised his hand. You can go ahead with your question. Please unmute your mic. Hello, Mr. Samir, can you hear me?
Samir, you can unmute or you can even type on the chat if that's fine with you.
I think he's not available. We'll go on to the next question.
Okay.
IT export company is eligible for 90% refund within 7 days.
So yes, the recommendation is, in fact, there are for exporters, there are already set of rules. Okay. Now the recommendation is that for all type of exports, zero rated as well as under inverted duty structure, for both this type of refunds. So IT companies who are exporting zero rated would also be allowed the benefit of that, and they should be able to get 90% upfront. That's the recommendation.
Okay, are there any more questions?
So here just one point of caution. So while the council has recommended that 90% should be given upfront, unfortunately there may be a gap between policy level pronouncement and the ground realities. So that we will have to be mindful of. As a taxpayer, if this is made as a part of law, I would be entitled to claim that upfront. And there are also provisions which says that if refund is not granted as per the timelines given by the law, the department will have to pay interest to the taxpayer. So one, I can ask for an upfront refund. Second, I can also ask for interest if my refund is getting delayed. But the practically in the GST officers at times also request the taxpayer saying that आप मेरे को later दिख लीजिए, you will not claim interest and I will process your file. So that are all practical ground realities which may be different from what is at a policy level. But if you ask me strictly as per law, as my entitlement, as my right, yes, I can expect payment with upfront within 90% of that upfront. And if not paid, I can also expect an interest on that.
Okay, there's one more question. Current reduction in GST will reduce GST collection. In future, do you foresee an increase or addition of services under GST which is currently not taxable?
So right now, which are not taxable is alcohol for human consumption and specified petroleum fuels. Barring that, anything and everything is under GST. So maybe you exempt it, with a nil rate or at a lower rate and all those. But the only which are out are petroleum fuels and alcohol for human consumption. Here again, there have been various representations and government has been vocal in saying that they eventually want to subsume these sectors also in GST. So one, as a subsuming of these sectors, yes, I do expect that that would be eventually subsumed into GST. May not be quickly, but in times to come, definitely yes. And I'm also, in clear advocacy of that all sectors should be under GST. That is point one. Second, the reduction in rate obviously, has resulted into a hit in terms of revenue collections, but they have also tried to compensate it almost 50% of that by way of reduction in taxes on sin products and luxury goods. Right? So 50% they were already in the same rate change, which is going to be effective from 22nd September. The government has taken that, where they have levied a higher rate of 40%. But yes, again, the government will have to ensure that, the fiscal deficits do not, demotivate the collection path and, the progress path that on which India is set up. And therefore, the rate changes may happen, may not be in the very near future, but in times to come, yes, there would be need to revisit this again.
Okay, we have two more questions. Dear sir, please advise supply of multimodal transport of goods within India. 5% where no leg of transport is through air with restricted ITC, that is 5% of input services of goods transportation. What is the meaning of 5% restriction? Is it on ITC or taxable supply of input services procured from the supplier?
No, so this restriction is, an ITC is on the service provider. So for the service provider, if he's not going to claim ITC, he has to claim a reduced, he will be allowed to charge a reduced rate of tax on output. So that is from the service provider's perspective. But if you are recipient of these services, there the ITC restriction does not apply to you. Same way, another example would be for hotels, for example. So hotels, again, a rate of 5% without ITC has been prescribed. But that ITC restriction is on the person who is into hotel business, not for the recipient.
Okay, one last. Can you please explain GST rate effect after 22nd September on GTA with ITC and without ITC?
So GTA right now with ITC is at 12%, which is proposed to be changed to 18%. So going forward on goods transport agency, where the transporter is claiming ITC, okay, today where he was charging 12%, he would be charging 18%, 18 going forward. Your ITC remains the same. Earlier you were getting the ITC for 12, now you will get ITC for 18. That's the only change. But for the GTA, if he is opting ITC, his applicable rate changes from 12 to 18. If he is not claiming ITC, the rate of 5% continues for him.
Okay, I think we are done with all the questions. Thank you everyone for your active participation in today's session. The transition to GST 2.0 will undoubtedly present both challenges and opportunities. What remains constant is our commitment at KC Mehta & Co. LLP to be a trusted advisors through this evolution. We understand that navigating these changes requires not just technical knowledge, but strategic foresight and practical implementation support. We encourage everyone to reach out to our team with any follow-up questions or consultation needs. Your success in navigating GST 2.0 is our priority. Thank you everyone once again for joining us. We look forward to continuing this journey with you as India's tax landscape evolves. Thank you, sir.
Thank you all. Thank you. Bye.